One of the key indicators to predict recession is yield curve. What we have seen in the US financial market last week, that yield curve gets inverted. And that means we have a much higher chance of getting into recession anytime soon. In Canada, we have all the major banks pushing Bank of Canada to raise interest rate by 50 basis points in one go, which means on April 13th, the Bank of Canada will update us on their monetary policy, and it is expected that they will increase the overnight rate by 0.5%, which means the overnight rate right now is 0.50. It will jump up to 1%. How this is going to impact the overall economy and the housing sector. In this video, we're going to touch upon that. So without further ado, let's dive in. So yield curve is a very good parameter or indicator to predict the recession going forward. And what we have seen in the last week in US financial markets, the difference between the 2-year treasury yield and 10-year treasury yield got inverted, which means we have a much higher chance going into recession anytime soon. Now, if you don't know how the bond market works, look at my video last week that I published and I explained how the bond market actually works. In short, bond has different loan contracts. That loan contract is issued by either corporation or the government. So for this video, we are actually focusing on the government issued bond contracts. So these contracts have a short term and a longer term. So the longer term has a higher yield or higher interest, and the shorter term bonds have a lower interest or lower yield. When the difference between the yield from a shorter term bond and a longer term bond gets reduced and reduced and reduced until such point when the shorter term bonds start yielding more than the longer term bond, this means the yield curve is inverted. As I explained in my previous video, that the bond market and the yield particularly, that tells you the market sentiment, where the market is heading in terms of the confidence and the way the capital is being moved. So when you see the yield curve is getting inverted, that means the investors are having less confidence on the market, having less confidence on the institutions like Bank of Canada and government in terms of how this will start yielding more return on their investment. So they start selling those short-term bonds and moving their capital to other safe havens like precious metals, commodity, oils, these kind of assets. So that's what we are seeing. So the market confidence is shifting, which is why the yield is jumping up on the shorter end of the bond, and this is pushing the fixed mortgage rate up. We have seen officially the fixed mortgage rate has gone up 4%. I think this is the first time we have seen since 2013. Now what will happen is this will push people to get more on the variable rate of the mortgage. But at the same time, Bank of Canada is also jumping up their overnight rate, which will have an immediate impact on the variable mortgage rate. So from a housing perspective, this is getting squeezed from all corners, right? So you have the supply coming up, the inventory coming up, which will give more options to the buyer. So the buyers are taking a step back, thinking, okay, maybe I should wait more to see, how this market is moving. At the same time, you have fixed mortgage rate jumped up to 4%, the highest since 2013. And in parallel, Bank of Canada is being pushed politically to raise variable interest rate, which is impacted by the overnight rate, which Bank of Canada controls. Right now, it is sitting at close to 2%. When they jump the overnight rate from 0.5 to 1%, the 2% will also jump to 2.5%. And it is expected that they will, increase that overnight rate multiple times in this calendar year. So overall, the housing market is being pressured from all sides, and that means it will have an impact on the demand side. So the demand will be significantly impacted. And in my opinion, the Bank of Canada is pretty late in the game right now, because this rate hike should have done way earlier last year, like 6, 7, 8 months before. Now we are seeing the market is shifting. The bond market is giving the market sentiment, which is already pushing the fixed mortgage rate up, pushing the buyers and the investor on the corner. And at the same time, Bank of Canada is waking up from a long sleep and thinking, okay, maybe we should increase the rates now. Now this is basically looking like a policy error is being executed. There was a policy error previously when they did not increase the interest rate for so long. They pushed the liquidity significantly enough in order to basically inflate the prices, not only on the housing side, but also any commodity sector, food prices, gas, car sales, anything that was being pushed by an enormous liquidity has contributed into rising inflation. The reason why all the economists and banks are pushing Bank of Canada to raise the rates is to control inflation. Now, keep in mind, inflation has two main reasons. Number one is the excess liquidity, which is basically as a result of infinite amount of money that they printed in the last 2 years. Of course, it has a major impact in terms of rising the consumer prices. But right now, the major reason of inflation is the self-imposed restrictions and sanctions that has killed the supply internationally from commodities perspective, like oil and gas and chip shortages. This war is creating a havoc in terms of fertilizers and potash and the wheat production and edible oil that is being produced by these two major countries, Ukraine and Russia. And when you sanction them, when you cut off the supply by a significant portion, it's going to inflate the prices because the demand is there, and you cut off the supply. What's going to happen with the demand? The demand will shoot up, and it will push up the prices as well. So inflation has these two reasons. They can control the monetary inflation by raising rates, but they cannot control the inflation caused by the self-imposed restrictions and lockdowns, because you cannot print oil, you cannot print commodity, right? You have to produce that, and you have to increase the supply by not imposing sanctions and lockdown measures. So I think this will be a policy error going forward. We will have a significant downfall in terms of seeing the activity in the economy, because this is where the yield curve is suggesting we are pushing into the recession, and all these policies that are being pushed by the government officials and Bank of Canada is going to further push us into the economy, because all of these narratives in terms of sanctions and restrictions, it is all optics, but at the end of the day, it is being paid by the consumer like myself and yourself. So we are being pushed to the corner, paying more for gas, paying more for food, paying more for housing because of their policy errors, their wrong policy decisions. So the outlook is not positive. As I mentioned in my last video, both the bond market and the rate hikes are being managed is going to even further deteriorate the economic activity. So it's not going to only impact housing, it is going to impact the economy as a whole, because housing is like a wealth effect for Canadians. So when the housing performs, it creates a positive wealth effect. If I see I'm being paper rich, then I'll start consuming more. I will start spending money into the economy. I will buy a boat, I will buy a car, I will go out on travel, I'll spend money on restaurants. But if the housing doesn't perform well, which means I'm getting poorer on the paper, that means my ability to spend money will be further reduced. I won't spend unnecessarily. I won't buy another car, I won't buy a boat, I won't go on travel and spend money on vacation. So it will have a direct impact on the consumer's spending. So people think housing crash and nothing will happen in the economy. This is absolute nonsense, because when the housing crash, it will create a negative wealth effect, which will contract the consumer spending overall and will have a negative impact on the GDP growth. And when this happens, remember, one person's spending is another person's earning. So if that one person is not spending money enough, the other person on the other end is not earning money enough. So it's a cycle that is going to be impacted overall. So I think this is going to be a policy error, as I mentioned. The timing is not right. This should have been done way earlier last year. But anyway, this is what they are heading towards. And we will have to see and keep our eyes open in terms of how are we going to manage our finances, because this will run into a recessionary environment where we will see less activity in the economy, which will create a negative growth environment, and it will be tough on jobs and employment opportunities. So hope this is helpful. Give me your thoughts on the comment section. Put your comments down below. Let me know what you think, and if I incorrectly say something, please let me know, correct me, because I'm also researching myself. Happy to hear your thoughts as well. So I'll see you in my next video. Take care.